Welcome to Series 2, Episode 2 of the In Her Financial Shoes podcast. Welcome to the In Her Financial Shoes podcast with me, Catherine Morgan, founder of The Money Panel, helping you to get financially naked. Listen in each week where we talk about that taboo subject of money. Listen to brutally real-life stories, step into our guest shoes and be left feeling 100% confident and in control. Oh, and we hate financial jargon, so don't expect any here. Small steps, big wins, let's go. Hi and welcome to the show. So in today's episode, we're going to be talking about some of the biggest myths that have become common barriers for women to start off on their investing journey. Now, for those of you that know me, I'm really passionate about getting more women to invest. And we're going to talk through some common myths such as, I don't have enough money to invest, investing's just for the wealthy, or it's just too risky, or I can't invest because I need to have access to that money, or you have to be an expert to invest in the stock market. And another big one, investing is the same as gambling. So some of these myths I'm going to unpack for you in today's episode. And I've invited a very special guest on to talk about this with me. And this particular lady is called Michelle Pearce-Burke, and she's the co-founder of a company called Wealthify. Now, Wealthify are a digital wealth management service. So they are the type of organisation that will actually manage money for you. So you haven't necessarily got to make the decision about where you're investing your money. But they do it in a very low cost way, using no jargon, very straightforward. And so I wanted to introduce you to Michelle on the podcast today. If you go onto Wealthify's website, actually, they have a section on here that says you can tell a lot about a person from their shoes. And they actually introduce everybody who works for Wealthify with a picture of their face and a picture of their shoes. And guess what colour Michelle's shoes are? Yes, pink stilettos. So very on brand with In Her Financial Shoes podcast. But all joking aside, Michelle has an array of expertise that she's going to share with you today. And really interestingly, starting off with her own investing sort of decision when she was just 11 years old. She was virtually using this platform called Neopets, which is a virtual game, whereas an 11-year-old, she was like practicing investing in the stock market, but obviously not with real money. And she went to her parents and asked them when she was a little older, actually, I want to start investing some money now. And I just think that's an incredible story. Something that sort of links into what we were talking about on last week's show, which was around how we can encourage children to be, having good, healthy habits from a very young age. And I just thought that was a really great example. So that's what we're going to leave you with at the end of the podcast today. So without further ado, I welcome Michelle Pearce-Burke. So a huge welcome to the In Her Financial Shoes podcast, Michelle. Thank you so much for joining us today.
Yeah, thanks for having me on the show, Catherine.
Oh, you're very welcome. So would you mind just telling us a little bit more about yourself, Michelle, and how you came about co-founding Wealthify?
Yeah, sure. Happy to do so. So I started my career in the financial services industry in quite a traditional role, working as a stockbroker and then discretionary wealth manager. But when I was still kind of relatively new in the industry, I was about 24, 25 years old. I got, although I'd only been there for a short space of time, I was feeling kind of very frustrated with the way things were being done as I saw it, in terms of high fees, high minimums, and lots of jargon in the industry. So I actually left that traditional world and I set up Wealthify, which is an online investment service that has the aim of kind of simplifying investing and opening and helping making it more accessible to more people.
And how long ago was that? What year did you launch?
So that was about just under 5 years ago now. Yeah, so it's been quite a journey since then. lots of ups and downs along the way, as you can probably imagine.
Yeah, I can imagine. God, so first question. So are you one of these people that, like me, fell into the industry, or did you choose stockbroking as a career?
No, I actually actively chose it. Strangely, I took a bit of a U-turn in my career because I started out studying medicine because I used to want to be a doctor. But I kind of quickly decided that medicine was not for me. Sick people in hospitals all the time. Lots of admiration for the people who can do it, but it kind of wasn't what I wanted to do. So I actively went and trained as a stockbroker. And I did actually genuinely love it, and I genuinely loved the industry. There were just a lot of flaws, as I saw it, in the way things were being done and how customers were being treated, which I wanted to be part of the solution, I suppose, not part of the problem.
Yeah, it's really interesting. It really sort of resonates with me. That's one of the big reasons why I set up the Money Panel, because I was in the banking sector for 20 years and felt very frustrated with how, partly because of the jargon, but just because of the focus on products and that being the kind of outcome for clients. We were measured against how many products can we sell clients. And whilst we all need products to solve a solution, it was never the starting point for me. And I got really frustrated that I wanted to be able to help people to have a better understanding of actually making decisions for themselves, rather than actually going into a financial advisor or going into a bank and being sold a product. So quite similar frustrations.
I think what you say, it's so true. You know, it's become less about the customer and it's become more about how much they can sell to you. And I think as the world changes, and I think one of the joys of the internet and of technology generally is it's made services more accessible, and it's kind of increased customer expectations, and rightly so, and put us much more in the center of that. And it's enabled solutions to be built that are much more customer centric. And is what people want and demand, and we can now deliver it to them.
Yeah, and this is one of the things I really want to get kind of into today in today's episode, is because one of the biggest barriers I find with my audience, which is largely women, of actually starting off their journey with investing, are kind of real common myths that I hear. So things like, I don't have enough money to invest, or, that's gambling. I'm not gambling my money, or it's too risky, or I have to be an expert to do some of these things. So I really want to kind of get into busting some of these myths so that people can, at the end of this, feel really confident that at least they know where to start with their journey with investing. That's what this series is all about. So, and I think you're right. I think with technology nowadays, it's so easy and simple to start that journey. And I think it's getting into the right habits in the first place is one of the things that I quite heavily promote with people, is getting into those habits. And then you can learn the stuff, the complicated stuff later. It really doesn't have to be complicated to begin that journey. And I was reading some really scary statistics on an article that was published this week by The Guardian around why more women should be investing and stop saving their money in cash. And the statistics in that article, which I can pop in the show notes, but they were saying that in 2015-16, which was the last year that they could actually measure this, was that 892,000 women invested in the government stocks and shares ISAs compared to 1.1 million men.
Wow.
And also that with cash ISAs, that 5.2 million women are investing in cash ISAs against 4.4 million men. So we're investing in more cash ISAs and less in stocks and shares. And I just think we need to do something about that, right? Because it's proven that as women, we do make better investors when we have the confidence to do it.
100%. Then there's no reason women shouldn't be investing as much as men. I do think that having spoken to a lot of men and women about investing and the habit, it is just this risk point that I think, and the confidence point as well, that I think a lot of women just feel like they can't take the first step, or it is riskier, or it is more complicated than it actually is. And it's a real shame, and something we should be talking about more. So I'm really welcome you doing this podcast. And
yeah, great. So let's dig into some of these then. So I've got seven kind of key myths that I hear very often from ladies that I work with. So the first one I hear a lot of is, I don't have enough money to invest. Investing's just for the wealthy. Mm-hmm. What would you say about that particular message, Michelle?
False. Completely false. I think this is a really common myth because it used to be the case. And I think if you're thinking this, it probably was true 10, 20 years ago. Certainly the firm that I used to work at, you used to have a minimum of maybe £100,000 that you needed to really start investing with.
Wow.
But as I kind of said before, with technology now, it's been able to kind of disrupt that industry as a whole. And it means that services can now offer investing for tiny amounts. So at Wealthify, for example, you can start investing with just £1 if you really want to. And with that £1, we'll build you a proper investment plan, which has got 10 different investment funds in it and can produce you a good percentage return on your growth. I mean, it's never going to make you a millionaire overnight, but it's just about getting started and taking the first step, I think. And
everyone has £1, right?
Yeah, everyone has £1, and even if it's just a little bit every month as well is the other thing. It's like it doesn't have to be throwing a big whack of money all in one go. You could just set up, £10 a month or £50 a month or something, just to start trying and testing and getting into that good habit, which you said earlier, Catherine, which I think is really important. Is it is about creating that habit, and when you're in the habit, it's so much easier just to keep on going.
Yeah, and what sort of age do you think that people should start thinking about creating these kind of habits?
I would suggest as soon as you start out working. Obviously, before then, it's very, very difficult because you don't have any income. But literally from your first job, I would suggest put something aside, even if it is, as I say, £5 a month, just something that you're not going to miss, but just to get you into that routine and start building your knowledge as well about really what's out there. And it is amazing how just a little bit tucked away every month can really start to add up when you look out sort of 10, 15 years. And especially if you are investing it and you kind of get the growth on the money as well from being invested in the financial markets, it can really start to add up. So I would say, yeah, start early. And also the good thing about starting early is you avoid this thing called lifestyle creep, which is well talked about, but it's so true in that you start earning a bit of money or a bit more money, or you get a pay rise and you just start eating out more or staying at nicer hotels or just buying nicer food or whatever, which is all fine within reason. But it is just about being aware of it, I think.
Yeah, it's so true, isn't it? You earn a bit more money, but then you just increase your expenses at the same time, and you just your standard of living just increases at the same time. So you're not really earning any extra money because you're just spending it.
Exactly. It's something just to be aware of, I think.
Yeah, so really, and actually now's a great time of the year to be thinking about that because, typically March, April time is the time when, if people are in employed jobs, their companies are announcing bonuses or pay rise increases. So if you're due or have already been told what your pay rise is, then maybe think about putting a proportion, if not all of it, maybe, dare I say, dare I challenge, into some kind of investment vehicle, because I think that, as you've just said, Michelle, the earlier you start this, the easier it is to then, not have to worry about it so much as you get into your 30s and your 40s. It's easier said than done, isn't it? When I was in my 20s working at the bank, giving people advice on investments, I wasn't investing, but I wasn't investing because I had a really emotional relationship with money. So every time I earned, every time I was paid at the end of the month, I would just go and spend it almost immediately on clothes and things because I had such a bad negative relationship with my body confidence. And so I just used to spend all my money on clothes thinking that it would make me feel better. And then it didn't. So then the next month I just did the same thing again and it didn't make me feel any better. So I think there was definitely an emotional connection with money. And I think that's where, for some people, they really struggle with understanding that it doesn't have to involve a lot of money. It can just literally be simply £1. Obviously, £1 a month is not going to get you particularly far, but it's just creating that habit. And if you're not in that habit, starting with £1 a month, I just think from a mindset perspective is really quite powerful.
Yeah, and confidence too, because you do start to, trust in whatever service you've decided to sign up for, and you can kind of hopefully see how it works, see the percentage growth on it, and understand that when you put more money in, it could experience the same types of returns.
Yeah, absolutely. It's this what we often have referred to as like compound interest. It's how this money just builds and builds and builds over time, which is essentially all compound interest is really. It's just money building on money that's already been invested.
Yeah.
Michelle, how old were you when you started investing? So, because obviously being a stockbroker at a young age, were you
Yes.
investing at that kind of point or?
Well, I actually started even younger than that. I bought my
Wow.
first share when I was 11 years old.
Oh my gosh, that's amazing.
I had a bit of an unusual introduction into the world of stock markets and financial markets, in that when I was even younger than 11, I think I was probably about 9 or 10, I used to play on this game, this virtual stock market game, through this company called Neopets, which it actually still exists today. If you're interested, you go to neopets.com and you get this virtual animal. And the idea is you collect points for this animal, and then you can go and buy things for the animal. You can collect points by playing games online, going on quests. You can have a little shop where you can buy and sell things and trade things, or you can go and play in these like virtual stock markets. So when I was tiny, I used to go and do this all the time, and I ended up becoming like one of the masters of the game and became really rich just because I used to go and play on this stupid virtual stock market. But it kind of got me hooked on like what the power of the markets and kind of what the potential growth is, and the kind of excitement behind it was as well, because I think we sometimes forget that actually it can actually be quite interesting, even though investing often has a reputation of being boring.
Well, I think that's the first time I've had a guest on that said they started investing at 11. So that's a record. That's amazing. I'm going to check that out, neopets.com. I'll put that in the show notes. Well, so I've got 2 boys. So, one of the things that actually as a partner, me and my husband, we always buy shares for each other on our anniversary, because otherwise it's just useless money, isn't it, that you end up buying a piece of paper or something that represents leather or whatever it is that you're celebrating. Yeah. And so every year, we've been married 9 years this year, and we buy shares that relate to whatever it is that is the theme of the anniversary. And just £100 shares we buy, and it's just been interesting to kind of track that over the years. But I think what's really important here is actually also to think about what is the difference between investing in direct shares versus going into a fund. And I think that's really important to talk about, because a lot of women say, and this comes on to the second kind of demisting myth, is that investing is the same as gambling. So Michelle, could you tell us a little bit about, from your perspective, the differences between buying individual shares like you may do on something like neopets.com, where you're trading directly in the stock market with individual shares, versus if I was to go into a fund of some description? What would be the differences between that?
Yeah, sure. And it is a really good point that you raise, because it's really important to understand the difference. And I think, so if I talk about my personal experience for a second, which kind of illustrates it quite well. So the Neopets thing was a sort of virtual online game. So just to clarify, you didn't actually buy any shares. But when I was very young, when I was 11, I then went to my parents and I said to them, can you help me buy a share, because I want to do this? And they didn't know much about investing or the stock markets at that time, but they could kind of see my enthusiasm and thought it was a good thing to do. So they helped me go online, and we managed to pick a share, which I bought. And a single share is basically just a holding in one single company. So for example, you could buy a share in Apple, which means if Apple does well because they release a new iPhone and it gets great sales, the share price will go up in value, as will the investment that you hold. So that's what I did, for example, when I was at that age. I put all my money into one company, one share. And in my case, the company went down drastically in value, pretty much went bust, and I lost all my money. So it was quite a high risk investment, because all my hopes were pinned on one company. It was a relatively speculative company. Mm-hmm. A fund is different to that, in that a fund is an investment vehicle which owns a number of shares underneath it, if it's a fund that invests in shares. So, for example, you might buy a fund that invests in US shares, and it might have a basket of, 100, 200, 300 different companies. And the main differences are, it tends to be a less risky approach to investing, because you really are spreading your money. You're not concentrating, or to use the analogy, putting all your eggs in one basket. And that tends to be a very good approach for people who are not wanting to have to research which is the best company and are not having to want to kind of edit their portfolio too often. It's more of a kind of buy and hold investment strategy, whereas I think with a share, it's higher risk and you have to be a lot more active and potentially more knowledgeable as well, because there's a lot of research you need to do to decide which company you want to invest in.
Yeah, that's a really good point. So, and again, that can be another common myth, can't it? That you have to be an expert to invest.
Yeah.
And can you remember the company? Who did you choose to invest in?
Oh, it was a biotech company that doesn't exist anymore today. It was a very random company.
So often what I find is when you ask people about like what products are you buying for your house, for example, or what phone do you own? You know, most people will have Apple or Samsung, or you know that they'll have a well-known provider that they're already using, and so in a roundabout way, we're already investing in these companies because we're using their products.
Mm-hmm.
So if if I was overspending on clothes, for example, and I was buying, I don't know, all in John Lewis, I should probably buy John Lewis shares because I'm investing my money in them. So I think sometimes when we think about it that way, we're not talking about, you know, throwing money on a horse race and just speculating with what kind of returns we might get. This is making informed decisions about the kind of companies that we want to be investing based on how we think they're going to perform. And I think individual stock selection is very different to making that decision to go in and set up an investment fund with £1, for example, because you're not necessarily having to choose the company that you want to be backing or investing, because as you've just explained, Michelle, you've generally speaking got hundreds, if not thousands of companies in that fund. So if one's going up and one's going down, then you're balancing out the risk.
Yeah,
as opposed to buying all in one share.
Yeah, and I think the other question is, how do you then go and pick the fund that you want to buy?
Yeah, great question.
And that's an interesting point, because you can go online. There are loads of online platforms that if you feel confident enough to, you can go and you can either buy a share or you can buy an investment fund. But then the question is, do you buy a whole of market fund that could invest globally all around the world, or do you buy a Japanese fund, and should you buy a bond fund or a share fund, or you can buy a commodity fund? And there's a absolutely vast array of different funds you can pick from, and it is really difficult to make a decision. And that's kind of why I set up Wealthify and why services like Wealthify exist, because what we do is you give us your money, you tell us how much risk you want to take on a quite simple scale from 1 to 5, and we then go and pick those funds for you, and we manage them on an ongoing basis to make sure that your money that's invested in them is working as hard as possible. Because we recognize that while some people want to do it themselves, and that's absolutely great if you do, there are a lot of people who just want to say, here's my money, this is what risk I want to take, you guys do it for me, make sure you're getting the best price and investing it in the right places. And I think that option works for a lot of people very nicely.
Yeah, particularly for beginners, I think it just takes away that fear of not knowing what kind of, as you just explained, what fund would where would you even begin to start investing? I think it's a really great place for people to start. You talked there about like assessing risk. And one of the other sort of big myths about investing is that they consider this word risk, that is the stock market is just too risky. It's not for me. Mm-hmm. What would be your how would you kind of reassure somebody who's maybe feeling that this is too risky for me? I'm not wanting to take that level of risk.
I think it goes back to how you invest. And if you are investing in one share, yes, it is very risky, but there are safer ways to invest, like the ways we just spoke through funds and kind of through buying a lot of them and getting professionals to help you do it. It's a hard one, because whenever we advertise in this whole industry, we have to put Capsule at risk warnings everywhere, which essentially means that your money is at risk and it can go down in value as well as up in value. But in truth, there are going to be ups and downs along the way. That's part and parcel of being an investor. But over the long term, there is so much evidence to suggest that you're going to actually make money over a longer time horizon, and that you should get back more money than you put in. And for your money to go to zero, which is a question that a lot of customers ask us, they worry, well, what if I lost all my money?
Yeah.
What the reassurance that we try and give them around that is, could it happen? Yes, in like a very, very Armageddon extreme situation. But essentially, for your money to go to zero, if you're investing in a wide range of investments, it would mean that the whole world would have had to collapse. It would mean that all of those companies that you're owning underneath in that fund, those hundreds or those thousands of companies, they would all have to go bust. And if you've got Apple going bust, HSBC, Disney, Shell, every company you can think of, all worth zero, then you're probably going to have bigger problems to worry about than actually what your money's doing. Probably going to have been some kind of nuclear event or alien invasion or something that's wiped out half the planet.
Isn't that funny though, how you said about, we could all probably recite this statement that says, the value of your, investment is not guaranteed and past performance is not a guide to future performance. And that, people do need to be aware of the risks. But isn't it interesting, if you buy a house, your estate agent doesn't say, if you buy this property, your house might go down in value, it might go up. It's really interesting, I think, how we communicate this to consumers. I think we have a lot of work to do around, regulation and risk, because risk to me is about uncertainty. We're not talking about speculating and throwing all of our money on one horse and it going down the pan. This is about making a careful, considerate decision to invest to grow your wealth over time. This isn't about, kind of speculating. But I don't think it really helps when we're bombarded with all of these risk warning statements, because it just turns people off from day one, doesn't it?
I couldn't agree more.
There must be a better way.
And people have tried to tackle it in different ways, but it is a problem. It's kind of a systemic problem in the whole industry, I think, in that we're being prescribed by the regulator that we have to say these things. And it's not even necessarily that we believe in them sometimes. I want to say them. It's just that we have to keep telling customers that. And it is good, you need the protection there, you need the sensible risk warnings in place. But I do certainly feel that we've gone to the extreme. And I also think that, you could go and blow your money gambling or in the lottery, and that literally could leave you penniless. But if you're choosing a sensible investing solution, I do feel that we kind of go overboard sometimes in what we need to say.
Yeah. You don't see the risk warnings on lottery tickets very much, do you? About this could lead you into getting into a mentality of gambling, and it's really fascinating. And
I downloaded the National Lottery app just the other day, actually. I was just having a play on it, and it is so addictive. And it did strike me when I was doing it that it's like I could just spend hundreds of pounds on this without thinking, and absolutely no warnings there shoved in my face, because it's very addictive.
Yeah, I mean, I did a Facebook Live earlier today. I had a letter hit my post box this morning from John Lewis saying, we've just automatically increased your credit limit by £1,000. And I was like, I don't want that, thank you. Yeah. And I find it fascinating that it's, this is about making conscious decisions, and, it is a conscious decision to be investing in the same way it's a conscious decision to be buying a lottery ticket. But this isn't about, we talked earlier on, actually, didn't we, about speculating versus investing and the differences between, well, in fact, there's a third option here. For me, it's about the differences between saving, investing and speculating. Mm-hmm. And saving is cash at the end of the day. It's putting money aside for short-term goals, holidays, things that you're going to spend your money on in a short period of time. Yep. And you're not going to get very much interest on that. But on the other side, you're not going to have any capital risk with cash. And that's great. But then over the longer term, if we're leaving money in cash, like these statistics are saying, then actually, we're really going to be impacted by things like inflation. Because if the cost of living is going up by, let's say, 2.5% every year, and we're spending, on our money sitting in cash earning 1% a year, then our money's losing 1.5% every year. Yeah. And just putting that into simple terms, means we do need to be doing something different. And that doing something different is about investing, not speculating as in putting money in Bitcoin or, throwing money on a horse, but it's carefully considered decisions, I think, that are really important.
Yeah. And that point about inflation is really strong as well. And it's something that I think we all know exists. We kind of vaguely think about it. We know prices are going up over time. But to think about it in the context of our cash, I don't think that really enters many people's kind of consideration in making an investment choice or not making an investment choice, because people think, well, the easiest thing to do, the safest thing to do is just leave it in cash in the long term.
Yeah.
But it really isn't, because by leaving it in cash, you're almost guaranteeing a loss. At least with investing, you're giving it a chance of growing. And it's to the extent where I think there was, I saw in the media a couple of months ago that there was some people campaigning around, should cash products, cash ISAs, for example, have risk warnings attached to them.
Yeah.
Kind of explaining that cash might actually not be the best option if you're holding your money for kind of 5 years or more. Really don't doing that.
That's so true. Yeah. Why don't we slap a risk statement on a cash ISA for a change? Like, your money could go down with inflation, and if you're not spending it.
What people are crying out for. I think there's a good chance that might actually happen, to be honst.
Great. Oh, I'm going to look that up. I've not seen that. I might join them, actually. Well, you touched upon as well there the word protection. Can you just talk a little bit, Michelle, about what protection do people have in place? If, let's say, we're not going to talk about it with Wealthify, clearly, but let's say that somebody chose, I don't know, Hargreaves Lansdown and invested some money with them, and the fund that they chose then went belly up, or something happened to Hargreaves Lansdown, for example. What protection do investors have for placing their money with particular companies?
Yeah, so if the company that you invest in goes bellies up, so in the example you gave, if Hargreaves has a fundamental problem with it and that company goes bust, then your money, it should be ring fenced. So any legitimate and proper financial service company should have it physically set apart from their own money, so that in the event that that company went bust, they can still pay back your money. Mm-hmm. There is a separate scheme in place as well, though, that kind of helps protect your money further, and that's I think it's a government scheme. It's the Financial Service Compensation Scheme, FSCS. And I believe the limit on that is £85,000. So if you've got £85,000 or less, then they will actually also protect that money. What I suppose they don't protect, and what is not protected, is the event that your investment goes bust. So say you go onto one of the platforms and you pick a fund or you pick a stock and that goes to zero, then unfortunately it's pretty unlikely you would get that money back, because that was your investment decision. But the chances of that happening, if you do a fund, is as I say, very unlikely. If it's one of the more mainstream funds, because it would require all the companies underneath it going to zero. It's more likely if you go and buy a speculative oil and gas stock, for example, or a mining stock that's kind of some fields out in the middle of nowhere, and you kind of got a one-way bet on it, because that is more of a gambling approach.
Yeah, sure. Okay. Yeah, great. So the 85,000 is protecting people if they're holding money in cash. I think it's slightly less, isn't it, for investing? It's 50,000 for investing. If you, I
think they raised it recently. I'd have to check.
Did they? Oh, yeah. Well, maybe. Yeah. We'll pop a link in. My understanding is the Financial Services Compensation Scheme protects up to 50,000 for investing and 85 for cash. So if you've got 85 grand in banks and then you decide to place an investment with a company and that company goes into liquidation, for example, then you're compensated up to 50,000 under the compensation scheme. But just something to mention, because I think that for some people they're quite aware of the compensation scheme for cash, but not always for investment. So that's kind of worth thinking about. And I think that the way that people can get some reassurance as to whether somebody is protected under that is to, often what I suggest to people is when they choose a company. So if you were looking at Wealthify, your website, for example, Michelle, you can scroll to the bottom of most websites and it will say on there that they're regulated and authorised by the Financial Conduct Authority, also known as the FCA. And that gives you can also go onto the FCA register, but that will give you some reassurance that the company that you're investing with is protected and regulated by the FCA.
Yeah, that's a good tip, because there are a few cowboys out there. So you do want to.
Yes. Yeah. And maybe let's talk about that. So how can people avoid falling into traps? with investing?
Do you mean in the context of companies that might offer investments?
Yeah, so I guess more scams. I'm thinking kind of a few people have contacted me recently. One lady actually that was contacted proactively by somebody by phone. And she ended up investing £10,000 with this company, and they ended up being offshore somewhere in the Cayman Islands, I think it was. She quickly found out that they weren't regulated by the FCA, which is one of the reasons why I mentioned that earlier on. And she lost that whole 10 grand. So how can people, I guess, other than looking for things like, are they regulated with the FCA, what are other tips, if any, can you think of for people avoiding scams like that?
One of the key things I'd say is if it sounds too good to be true, it probably is. So if someone's promising you fantastic returns with zero risk, then there's probably something that doesn't smell quite right about it. The default way I've got, it's not foolproof, but works most times, is literally just go into Google, type in the kind of keywords of the offer that you've seen and have a dig around. There's normally people who flag it up as being a scammy website. If you can't find any good and legitimate reviews, then that's also probably an indication. You could also look for kind of independent verification or accreditation that the service might have. So, for example, at Wealthify, we've got De Facto have just given us a 5-star rating, and De Facto are kind of one of the well-known kind of consumer industry bodies that will do proper due diligence on the company and award you a kind of a seal of approval. So there might be awards like that they've been given or by other people, but make sure it's something that's kind of recognizable, because it's easy for people to fake those as well.
So De Facto is an independent organisation, isn't it? So they're not biased in any way as to how they rate you.
Yeah, exactly. So entities like them are really good methods of kind of verifying what you're thinking.
Yeah, great. I can't remember how you spell it. I think it's DEFACQTO. I think that's how you spell De Facto from memory, but I'll pop a link in the show notes again to that, because I think that's another really good point, is to recognise some of the awards and recognitions and things that firms have achieved, and how you can maybe compare and contrast some of those compared to some of the other companies.
Yeah, very much.
One of the other demisting myths that I come across quite often is that people will say, I can't invest because I might need access to that money. So could we talk just a little bit about, first of all, what kind of access do people generally have with investments?
Yeah, so it's complex in the sense that there's a lot of different types of investments, and some of them will trap you in, and they will make you have sort of minimum holding periods on them. If you're buying just a very straightforward stock or a fund, though, on pretty much any online platform, Wealthify included, you should be able to sell it pretty much instantly and get your money back within a couple of working days. I think it is a misconception that you have to lock your money away. And I think this goes back a bit to the point about regulation and the fact that we're told as an industry that we have to tell customers this is an option for you if you're thinking about investing for 5 years or more. And I think some people sometimes read that as my money's locked in for 5 years, when that isn't the case. It's just, we recommend that you think about this as a sort of 5-year investment, rather than taking it out every day and chopping and changing it a lot. When actually, if you invest with us today and you decide next week I want my money back, then we'll sell it down for you the next day. And it takes a few more days than it would to get your money out of a bank account, but it's, you should have it back within a week.
Yeah. Great. And it's, again, that 5 years kind of comes into the standard risk warning, doesn't it? In my mind, is that people always come in and think, well, as advisors in the bank, we always used to say to people, if you can't invest for a minimum of 5 years, then you shouldn't be investing, which is right. In my view, I think that people should always be considering investing as a much more, medium to longer term savings goals. But I think in reality, it comes back to what you're investing for. What's the goal? What's the goal and what's the risk? Because if your goal is retirement and you're investing money for, your future self that you're going to use in 30, 40 years time, you can afford to take a different level of risk than if you're investing for if I was investing for my kids' university fees, for example, I don't want to keep it in cash because that's just going to get eroded by inflation. But at the same time, I don't want to be taking the same level of risk that I probably would do for my retirement bucket. So I would perhaps take a little bit more of a cautious approach to that because I can't afford to see it, particularly as I'm approaching the time when I might need to access it. I can't afford to see it go up and down all over the place when I've suddenly got to start paying out university fees.
Yeah, I think the 5-year rule is right in principle, and it is what you should have in your mind. But, circumstances change, and, you might lose your job in 2 years' time, which you just hadn't foreseen, and you might need access to that money. And I think it's comforting to know that you can still access it. And I think the other thing that people like with some of the slightly newer platforms is the visibility that you can have to your money. Whereas once upon a time it was that you bought investments and you would have a paper share certificate which you had to lock away in your safe and make sure no one stole it, and you didn't really know what it was worth or what it was doing. Nowadays, you can log on to most apps and you can kind of see in real time what your money's worth, where it's invested, and lots of other information about your account. And you can add or withdraw money at the click of a button as well. So it definitely is a myth in this day and age.
And how often do you think people should be reviewing their investments?
I think I personally look at my money once every 3 months. So sort of about 4 times a year, just to check in on how it's doing generally. What the fees are that I'm paying and how markets have done. Though obviously I've got a pretty good sense of where things are given my job. But I think that feels about right, I would say, for most people. You can check it more regularly, but I think there's a risk, especially if you're investing, that you start panicking unnecessarily, because there's going to be downs. There's going to be downs along the way. And the worst thing you can do is withdraw your money when the market has a blip, because at that point, if you take your money out, you're actually locking in that loss, if you like. So you're actually making a loss. Whereas if you just ride it out, it will tend to go up in value over the longer term, which is why I wouldn't really recommend doing it on a much more regular basis than that.
Yeah, it's really interesting. We're going to do a separate episode all around behavioural finance. We've got an expert coming on to talk to us about that, because I think that you're quite right. I think sometimes if we check it too frequently, then we will allow the emotional side of our brain to take over and make decisions that aren't necessarily the best ones, or the most rational decisions to be making at that time based on what the markets are doing. I guess in the same way as you wouldn't necessarily check the value of your property, very frequently. You might from time to time, every couple of years, check in on it and see what it's doing. But you're only really in reality interested in what the property values are if you're looking to move house or to sell. So I think it's sometimes it can be useful to just have a bit of a check-in to see what's going on, but for some people that may not be the best thing to do, because it might panic them and they think, oh gosh, I can see the investment's gone down by a few pounds, or and then they can start to make more emotional decisions rather than rational decisions.
And it's like with your pension as well, because one thing that people often forget is if you've got a pension through your workplace or something, it's probably invested as well. So you probably are, most of you listening, I expect, already investors, but may not quite realise it. Have made the connection, and you wouldn't necessarily check on your pension every day to check how it's gone up and down. In fact, I think if most people check on their pension once a year, they're probably doing quite well. So it's probably a similar principle to that.
Yeah, I find that fascinating as well. The fact that you're absolutely right. We are all, especially now with auto enrollment, we're pretty much all investing. We're all investors. Like just saying that out loud is like really powerful. But how many of us sit and review our pensions? Not many.
And all these questions that we've been talking about today, and about risk and worries about things going down to zero, the same, your pension's doing a very similar thing, and people don't worry about that going down to zero quite as much because they can see it's well over the long term, will do well. So it's just trying to apply some of that logic to your sort of medium term goals as well. Yeah,
absolutely. And one final thing to finish on, another kind of block sometimes that comes up for people is investing's too complicated. Things like, do I invest in an ISA or a JISA or a LISA or a pension or a SIP, or all of these and I shouldn't say any of those because I don't talk jargon on this podcast. But things like stocks and shares ISAs, junior ISAs, pensions, self-invested personal pensions, it can become quite a minefield for people to think about, well, where do I even begin to think about what kind of wrapper should I be putting around that investment? So what would be your advice to anybody that's on that starting journey, Michelle, that's looking at, well, should I go into an ISA or a pension or neither of those?
I mean, it depends on your personal circumstance, which is not a particularly helpful thing to say. But the kind of common rule of thumb is if you don't have an ISA, I would start there, because you can put up to £20,000 a year in an ISA and it will be sheltered from tax by the government. So you won't pay capital gains tax on the investments that are held within it. Yeah. Whether it's a stocks and shares or a cash ISA, you can, it's a little bit more flexible now, and that you can kind of mix and match them a little bit more than you used to be able to. But I do feel like the government have made it overly complex. So
yeah.
I would suggest as a stocks and shares ISA for most people is normally the most sensible way to start, or a cash ISA. But it just depends if you want to take the investment risk or not.
Yeah, I think I would agree. I think it is dependent on your personal situation, and your tax position as well can depend vastly on where you should be investing that. But I think the misconception for me is around people say, oh, I'm in a stocks and shares ISA. Oh, but I don't invest in the stock market, because they don't realise that there's, without being kind of patronising here, that the stocks and shares ISA is just the wrapper that sits around that fund or those shares that you're buying. It's no different. It's almost like I always describe it like a bowl of boiled sweets. Is you could put a pink sweet wrapper around that boiled sweet, and then you could have a sweet next to it that's got a purple wrapper around it. So the pink wrapper could be the stocks and shares ISA, the purple wrapper could be the pension wrapper. It's the same boiled sweet underneath, assuming you've got the same fund in the ISA as you have with the pension, but it's just what wrapper are you using to protect it from tax, and that's essentially what you're deciding between is are you protecting it from tax in a stocks and shares ISA where you can still access it potentially if you needed to, and if you're putting it into a pension, obviously you can't access that under current rules until you're 55, so it's a kind of longer term wrapper. But in essence it's the same element underneath it. It's just which wrapper are you choosing to protect it from away from tax.
I like that analogy. That's a really good analogy.
I think it's just I do a similar analogy with a glass, sort of different glasses and water that you have inside it. But I think it's just that misconception that what is a stocks and shares ISA, it is just a wrapper that's put around a basket of your choice, whether that's direct shares like Michelle did when she was 11 or virtually anyway, or whether you choose a company like Wealthify who selects all of the funds for you. You haven't got to worry about making that decision when you're starting out that journey. So I think it's just easy analogies like that just make it more, without being patronising, obviously, for people to understand. So one final question then, Michelle. So you talked a little bit about how your investing journey started. A bit of a personal question here, if you're happy to share. How are you investing personally right now with your money?
So, I mean, I'm biased, but pretty much all of my money at the moment is in Wealthify, as you might imagine. I have just a very simple stocks and shares ISA set up that I just top up every year, and I use as much of my ISA limit as I can, and I invest it into what we call an adventurous plan, which is mostly stocks and shares, but it's also got a few sort of bonds and other investment types in it as well. So it's quite a big basket of investments.
Yeah. Great. I kind of expected you to say that, really, didn't I?
Yeah, I mean, that's about it. Unless you count my dabbling in the national lottery, which I did last week. So what inspired me to do that?
Fabulous. Well, thank you so much for joining us today. Just one final question. Do you have any particular apps and things that either you'd recommend that people consider, or that you particularly like using to make, it doesn't have to be financially related, but that either make your life easier or your financial relationship easier? What kind of apps are you using at the moment on your phone?
Yeah, so I mean, in the financial space, two apps that I really like are Bud and Yolt, which are like money aggregator apps. And Wealthify has actually partnered with them, but loads of other companies are too. And essentially, it enables you to kind of see all your finances in one place through quite a simple to use interface. And I find that helps me because I've got a couple of different bank accounts for various reasons with different providers. So I really like that. And I also like Starling Bank, which is one of the new challenger banks that have come out. And I find using them is a really helpful way to kind of track my spending and actually see where I'm spending, what I'm spending, and make payments as well really easily to people. I think that's a great feature on some of those newer banking apps.
Yeah, I'm a massive Starling Bank fan. I think for those people that have followed me for a while know how much of a Starling Bank fan I am. What was the other one you mentioned? Did you say Budge?
Bud, B-U-D.
Oh, Bud.
It's this kind of does the same thing as Yolt as well, which is Y-O-L-T. And they're the aggregation apps.
Ah, cool. Oh, I'll check that one out. I've used Yolt before. I'll pop a link to that in the show notes. But I haven't come across Bud before, so I'll have to have a look at that one.
Yeah, they're doing some more in the kind of business space as well. So they power some of the banking apps as well.
Okay.
Banking apps that are being redesigned.
Cool.
Awesome. HSBC, for example.
That's who I used to work with. Yeah. Oh, great. I'll have a look at them. I haven't heard of them before. So thank you. I mean, there's so much technology at the moment, isn't there, available to really make it easy for us to
have really is
insight into our money.
And I think it can be a little overwhelming at times because there are so many new apps out on the horizon. But I think if you can find one that you like and works for you, then it does really transform how you can think and look at your money.
Yeah, fabulous. And just I keep saying one final question, but I've just come up with another question for you, if you don't mind. Okay. Do you have any particular book recommendations that you feel, particularly from an investing perspective, actually, do you know of any books, like good books that you've read that could help people with, who may be sort of starting off their journey with investing? I mean, I've come across a few in my time.
Yeah, I'm trying to think of some. I don't think, unfortunately, that the investing books I read will be very interesting for most of your listeners. But I can't think of any for beginners off the top of my head. But I will certainly let you know if I think of some.
Yeah, no, or any other book recommendations that have had a powerful impact on your life, or perhaps in your business, helping you to grow your business.
Not so many, to be quite honest. I'm more of a fiction reader, I have to say.
Are you? Yeah, yeah.
I like.
What's the last fiction book that you've read?
Detective novel or something like that.
Okay, yeah, awesome, yeah. I try and read as much as I can, but I'm finding actually going into like audio books and podcasts. I'm just easier for me to digest nowadays than
I've just got into podcasts actually in the last sort of 6 to 12 months, and that's kind of all I'm doing at the moment.
Yeah,
and Netflix, of course.
And Netflix. Oh, what's on the Netflix channel at the moment?
Oh, too many things. I just love everything Netflix related. I was a bit of a late comer to it, but Prison Break. I've recently just finished that whole.
Oh yeah, we finished that a couple of months ago. It's great.
It really is good.
Yeah, fabulous. Awesome. Well, it's been lovely to get to know you a little bit more, Michelle, and I'm sure we'll have you back on the podcast again in the series, because I know that one of the areas that you're really keen to talk about is ethical investing, and it is an area that I know that a lot of women are very, very interested in, and we're seeing a lot of trends around ethical investing. So I'd love to have you back on the show again to talk about your insights into that area, if you would be happy to return.
Yeah, I'd love to be back. Thanks for having me on the show. I've enjoyed it.
Oh, you're very welcome. Thank you so much for your time, and we'll catch up with you again soon.
Okay, thank you.
Thanks, Michelle. Bye-bye. So So I hope you enjoyed the show today. A massive thank you to Michelle for her time. And I really do hope that going through some of those myths is giving you a little bit more confidence to perhaps start thinking about beginning that investment journey. Now, for those of you who want to explore a little bit more about Wealthify and their services, they have actually given me a special link that you can click. And if you start investing through this particular link, then as a limited offer for Money Panel subscribers or podcast listeners, then they'll actually reduce their fees to zero for the first 12 months. So I'll pop all the details of how that works into the show notes, or if you're reading this on the blog, you'll also find the link in there too. As always, I think it's really important that people should be able to make their own investment decisions. So do take a look at the Wealthify proposition. And if it intrigues you, then you can find out more on that link. Obviously, there'll be lots of other investment firms out there too. So it's important that you kind of have a little read and see what you think and make your decisions based on information. And finally, I just also wanted to make you aware as well that I do have an online course called In Her Financial Shoes, as you would expect. And this particular online course has been designed specifically for women to help you run through all of the jargon and complicated choices around beginning your investment journey, where you can be left really feeling empowered to make some decisions to start investing. Now, the online course is split down into several different modules, and they're basically a series of videos and workbooks that you can work through completely in your own time. And we cover off aspects such as building your capsule wardrobe. So this is all themed around the female wardrobe, makes it just a little bit fun. Building the capsule wardrobe, what are the basics of investing that you need to be aware of? Choosing the right heel height, this is all about understanding risk. Choosing the right brand and the shopping experience, that's about understanding the differences between shares and funds. So some of the things that we started to talk about on today's episode. How to avoid the fashion faux pas, so how our own behaviours can lead us to make bad decisions and how to stop them. Again, we alluded to that in today's episode, and we will be talking more about that in future podcast episodes in this series. We also run through choosing the right storage solution, so things like ISAs versus pensions. We talk through how to plan your shopping spree, so when is the best time to be investing in the stock market. We talk about what's the differences between active and passive, and that dreaded word, asset classes. What does all of this jargon mean? We also talk through ethical investing. This is another real sort of hot topic and trend in the markets at the moment, particularly for women investors who want to sort of align some of their values and ethics before they begin investing. And we then talk around sort of how to choose the right platform and the right company to be investing with. And then finally, polish and reheal is about, assessing performance and what next. What do you actually do once you've chosen that investment? How do you understand things like charges? And where to go next. So that course, it's what we call an evergreen course. It's available all of the time. It's on the website at www.themoneypanel.co.uk. So do jump over and have a sneak peek if you want to progress your knowledge around investing. And I hope you've enjoyed the show today, and we look forward to bringing you another show next week. Take care.